Interest rates have a significant impact on how people's personal and national finances are shaped. Interest rate fluctuations can have a big effect on consumer behavior, economic growth, and borrowing costs. People and governments must manage the opportunities and problems that arise when rates increase or decrease. Since interest rate changes have an impact on consumers, businesses, and national economies alike, it is imperative to comprehend these dynamics in order to make efficient financial plans and policy decisions. Number 7. Increased borrowing costs. Interest rates and borrowing prices have a fundamental link in economics that impacts governments, corporations, and individual consumers. Interest rates offered by financial institutions for loans climb in tandem with increases in interest rates by central banks, like the U.S. Federal Reserve. For example, mortgage rates may rise from 3.5% to 4%, or higher, in response to a 0.25% increase in the federal funds rate. This seemingly minor adjustment can have significant effects. For example, a borrower taking out a $300,000 mortgage over 30 years would have to pay an extra $50 to $100 a month. This can result in additional interest payments totaling tens of thousands of dollars over the course of the loan. The effects are immediate and frequently severe for individuals who currently have variable rate loans, such as credit cards or adjustable rate mortgages. Many people may find themselves unable to fulfill their financial obligations when their monthly payments increase, which might result in a surge in delinquency rates and even defaults. Macroeconomically speaking, consumer spending tends to decrease when borrowing prices rise because people are less inclined to take on additional debt for significant purchases like homes or cars. The economy may grow more slowly as a result of this spending drop, since companies may reduce production or lay off employees in response to fewer sales. Number 6. Strain on household budgets. Budgets for households can be severely impacted by the financial strain brought on by rising interest rates, especially for those with heavy debt loads or those who are already living paycheck to paycheck. Households with adjustable rate mortgages may experience a significant increase in their monthly payments when their loans reset as interest rates rise. For instance, a family's monthly payment may increase by several $100s if their ARM changes from a 3% rate to a 5% rate. Families may have to make difficult financial decisions. As a result of this abrupt increase, they may have to reduce spending on necessities like groceries or medical care in order to cover the increased costs. Additionally, because each loan may have a different interest rate that adds to the total increase in monthly financial commitments, families with several debts, such as credit card balances, auto loans, and school loans, are especially vulnerable during periods of rising interest rates. These increasing payments over time might put households in a debt cycle where they may use credit cards to pay for daily expenses or take out personal loans to make up the difference, which will make their financial problems worse. Families find it difficult to prepare for emergencies or retirement in the face of mounting debt, which has an impact on both present and future financial planning. Number 5. Reduced consumer borrowing. Consumer borrowing behavior tends to change dramatically when interest rates climb. Increased borrowing costs cause many people to reevaluate their financial choices. They could decide not to take out loans for significant purchases like homes or cars because of the higher financing charges. For example, if mortgage rates rise sharply, prospective home buyers who were previously keen to enter the market might put off their purchases, particularly if they expect additional increases. This reluctance extends beyond home. If consumers believe that the costs of borrowing exceed the advantages of making an immediate purchase, they may steer clear of financing options for large appliances or schooling. Since consumer spending makes up a sizable amount of GDP in many economies, a decline in consumer borrowing has wider ramifications for economic growth. Retailers may see lower sales volumes as fewer consumers are ready or able to finance new purchases, which directly affects demand for goods and services across a variety of sectors. Businesses may modify their operations in response to this decline in demand. They may lower production levels, fire employees, or put a halt to expansion plans because of lower revenues and unstable market circumstances. Number 4. Impact on debt types. Different debt instruments are affected by fluctuating interest rates in somewhat different ways, which affects how customers handle their money and make plans for future borrowing requirements. Variable rate debts are especially vulnerable to changes in interest rates. Borrowers who have these loans immediately see an increase in their monthly payments when rates rise. Credit cards, for instance, frequently feature variable interest rates that change according to the state of the market. When interest rates rise, customers who hold balances on these cards will notice an almost immediate increase in their minimum payments. Borrowers may become more dependent on high-interest credit choices, or, in extreme circumstances, file for bankruptcy as a result of this circumstance if they are unable to keep up with the increasing payments. On the other hand, because the interest rate stays the same over the course of the loan, fixed-rate loans give consumers greater certainty. However, when market circumstances improve, new borrowers looking for fixed-rate mortgages or personal loans will have to pay higher rates. This dynamic may cause current homeowners with advantageous fixed-rate mortgages to stay in their current residences rather than sell and buy new homes at higher financing costs. And it may discourage prospective homebuyers from joining the market during times of rising rates. Number 3. Government debt servicing costs. Rising interest rates affect more than just businesses and individual consumers. They also have a big impact on government budgets because of higher national debt servicing costs. In order to raise money for a variety of expenses, such as social programs and infrastructure projects, as well as to cover budget shortfalls during recessions, governments usually issue bonds. New bonds must provide higher yields when interest rates rise in order to draw in lenders. This leads to greater interest payments on both freshly issued bonds and existing debt that is refinanced at higher rates when it matures. A government's annual interest payments could climb from $20 billion to $40 billion, for instance, if average interest rates rise from 2% to 4%. And it has $1 trillion in outstanding bonds. This is an extra burden that needs to be managed within its financial limits. Therefore, the government may experience greater budget deficits that make fiscal management measures more difficult if government revenues do not keep up with these growing costs, which is frequently the result of slower economic development. While trying to maintain basic services like healthcare and education, this situation can force governments to make tough decisions about tax increases or spending cuts. Prolonged periods of high interest rates can also make it more difficult for governments to invest in infrastructure or effectively respond to economic crises. Number 2. Economic growth slowdown. Interest rates and economic growth have a complex but important relationship. Higher interest rates can impede economic growth by severely reducing consumer spending and company investment. Businesses frequently scale back plans for expansion or capital investments when borrowing becomes more costly due to rising interest rates, because the expected profits might not outweigh the higher expenses of financing these projects through loans or credit lines. A business thinking about constructing a new factory, for example, might decide against it if financing costs increase dramatically. Rather than investing in expansion prospects that could boost local economies and create jobs, they might decide to save money or make cautious investments in less risky ventures that have lower returns but less risk exposure in unpredictable economic times. In a similar vein, consumers may cut back on their spending in response to higher loan payments and living expenses in general. This decline in demand may cause companies in a variety of industries, including manufacturing and retail, to lower their production levels and possibly fire staff or cancel hiring plans entirely because of lower sales forecasts brought on by weakened consumer confidence. Number 1. Inequality in debt impact. By disproportionately affecting various income groups according to their access to credit and capacity for efficient debt management, the consequences of fluctuating interest rates frequently worsen already existing economic disparities in society. When borrowing costs are low, wealthier people usually have easier access to credit at lower rates. They are more likely to be able and willing to take advantage of this opportunity for long-term wealth-generating activities, such buying. In contrast to lower-income households that might struggle with rising debt costs and lack access to similar investment opportunities at favorable terms due to systemic barriers like lack of education about financial products available in communities facing socioeconomic challenges historically rooted within society itself. Redlining practices. Higher-income households may be able to accumulate more wealth through the purchase of additional properties or stock investments. Conversely, lower-income households frequently bear the brunt of higher borrowing costs when interest rates rise sharply, as has recently happened. They also lack the resources to take advantage of the investment opportunities enjoyed by wealthier individuals, which can make it more difficult for them to manage debt and achieve upward mobility in an economy that is becoming more and more stratified, along lines defined by patterns of wealth accumulation over generations past, leading into the realities faced today by various demographics throughout society as a whole. Stakeholders can make well-informed decisions that support financial stability and equitable growth by acknowledging the connections between interest rates, debt management, and general economic health. If you liked our video, please hit the like button and subscribe to our YouTube channel.